Hello, I hope you're enjoying your summer. A lot going on, of course. Today I wanted to take some time to go through the new tax law, or what's been called the Big Beautiful Bill, of course. So I thought it would be helpful to go through some of the provisions in this new bill, how it pertains to, I would say most people. It is almost 1,000 pages long, so we're certainly not going to spend that much time going through all of the provisions. Obviously, any bill we see nowadays has a lot of things in there that are not relevant to everybody, but we certainly do see things in there that are relevant to most of us. So I wanted to break it down into some of the provisions that are now going to be permanent versus some that have a expiration date or are temporary. So first and foremost, what we see in the bill is that the tax rates from the prior Tax Cuts and Jobs Act back from 2017. So if you recall back then, a lot of the rates came down approximately 3% per marginal bracket. What does that mean? That means that the 10% marginal rate that we had back then stayed in place. That one actually didn't change, and it doesn't change here either. What was the 15% marginal rate after that became the 12% rate. 25% then became 22%, and so on and so forth. So all of those rates from that prior bill had an expiration date of the end of this year. So we all would have been experiencing an increase in our income tax rates come 2026, and now those have been made permanent. So long story short, no increase in our tax rates come next year. So you won't see a whole lot of changes then versus the alternative. In addition, we do see that the standard deduction rates remain in place. Again, back then, those rates were effectively doubled, and those now will remain in place going forward as well, along with the ability to continue to deduct mortgage interest, for your primary residence. Another change that has been made permanent, the estate and gift tax exemption. So this has been around for a while. It was at a very low number years ago. Even back when I started over 20 years ago, it was only around $400,000 that each person could gift, if you will, or transfer as an inheritance from their estate. Now that number has been increased. It's around $13 million today, and starting next year, that's going to be increased to 15 million, made permanent, and also then indexed for inflation. So for the vast majority of people, we don't have to then worry about passing along an inheritance to our heirs and having any of those dollars exposed to estate tax. Still might be some income tax. Those are other questions that we can certainly address if you are curious. Obviously, reach out. But for now, that estate and gift tax exemption amount is definitely going to be made permanent going forward. That's good. Charitable contributions. This was one that is going to begin next year, because most charitable contributions have what's called a floor. And for most people, that floor then is their standard deduction. So unless you are potentially gifting larger amounts, there hasn't been a tax reason to provide those charitable contributions. Obviously, you should, because it's a good thing to do, makes us feel good, helps everybody else out there. But now there is going to be an additional tax rationale for giving those charitable contributions. So even if you do not itemize going forward, you still can claim a tax deduction for a charitable contribution. So as you can see, it's going to be $1,000 if you file single and $2,000 if you file married. At the end of the day, don't stop giving. If you already do, if you don't, start, and you can get a little bit of a help on your tax return for that endeavor. Good news there. These new child accounts, we're still looking to see what the viability of those might be. Obviously, incentives to save for college and even then for retirement for children, important. I talk about those all the time. Now we have an additional kind of reason, if you will, to save for those younger individuals. One provision that we're seeing here is that there is the ability for an employer, so we'll have to see how many employers decide that they want to hop on this bandwagon to kind of help or incent the savings for these. Now think about if you're employed, your 401k, a lot of times your employer, incents you to save in that account with a match. This would be something kind of similar to that. They would be investment accounts. Not that we don't already have the ability to do these or accounts available. So, I can't say that this is like knocking it out of the park as far as something new. It's just another way to potentially save for those young folks. The more options and opportunities we have to save for younger folks, the better. Get them investing young, show them what's going on in there. I do that with my own children, and see how those can definitely help going forward. It's never a bad idea to save for college, for future, for any of those kinds of things. And there are some provisions now, additional provisions, I would say, to help along with that. There are more. Obviously, we don't want to spend all day on this, but there are some temporary changes. You have to make compromises in these bills, of course. So we see some of the things that are new, but may not last. So similar to the prior bill, where it had this 2017 to 2025 kind of expiration, now we have some of these provisions that are going to be 2025, and in this case, 2028. So this started out as the Social Security, the kind of tax-free Social Security provision that they wanted to get in, didn't end up actually being specific for Social Security. So what does that mean? Well, you can see here at the top that it starts for folks who are age 65 and beyond. Well, you can turn on your Social Security as early as age 62. So for someone or even couples who turn that Social Security benefit on early, if you will, between 62 and 64, this particular deduction will not help you on your return, not until you get to age 65. So they're providing an additional deduction, $6,000 for single, $12,000 for married on your return. So the two provisions, number one, have to be over 65, and number two, you do have to be receiving Social Security, going forward. So as with a lot of these deductions that come out, there is an income threshold associated with it. They don't want to give higher income single or married folks, too much benefit, of course. Lots of tax provisions have these kinds of phase outs for higher income individuals. But what we can see here is that on the low end for a single individual, age 65 or over, in addition to your standard deduction, in addition to the current age 65 additional deduction of $2,000, now we have this temporary $6,000 deduction. So in total, you can then take $23,750 as a all-encompassing standard deduction now on your tax return. And on the other side, we see for married filing jointly, that number goes up to $46,700 with all of the kind of standard deductions now that we will have in place going forward for at least the next couple of years. And we'll see if this one survives past 2028 or not. I'll keep you in the loop, of course, on that. Back in 2017, they reduced the ability for us to take standard deductions on our tax return, and at the same time doubled, in effect, doubled the standard deduction rate. So what that meant is that a whole bunch of people who used to itemize back then now switched over to the standard deduction. And as we can see here, for those of course over age 65, the standard deduction is becoming even more generous. But what about the rest of us, right? So the SALT cap, which is state and local taxes. So your state income taxes, your property taxes, your mortgage interest, all of those kinds of things that would add up to be itemized deductions, absent charitable contributions or medical expenses. Those things are also included in itemized deduction. So all of those were limited to $10,000. And now, as kind of a compromise, they are increasing that to $40,000. So we'll see. I'm not confident that a whole new crop of people are going to be able to itemize, but those who do have a lot of those expenses or costs that would allow them then to itemize now will have a higher limit, if you will. But again, they put an income limitation in there as well, so you can see that there is definitely a threshold that if you're a higher income individual, your itemized deduction or the SALT cap within your itemized deduction is still then going to be limited. So again, this is temporary. I don't see that this is going to really affect a whole bunch of people. It certainly will be more appropriate for some of the higher income individuals or those that actually do have itemized expenses. So if your mortgage is paid off, if you don't pay a lot in state income taxes, which a lot of retirees don't, and here in Michigan, that's going to be even less, we probably will end up looking for still the standard deduction for most of those folks. Car buying. So along with the increase in the deductibility for state and local income taxes, now a new provision here for purchasing a vehicle and really purchasing a vehicle with a loan, right? Having a car loan and the ability now to be able to deduct the interest. Good news is that you don't have to itemize in order to be able to deduct this interest that you would pay. It is only on new vehicles. It is not going to be if you wanted to purchase a used vehicle. They kind of want to goose up, I guess, the auto manufacturers for their ability to sell new cars into the market. And there is a provision in there for final assembly required in the U.S. part of trying to bring some of that production here back into the U.S. And it is for personal use vehicles only. So any company vehicles don't receive this provision. So again, there is an income phase out limitation. So if you're over 100,000 for modified adjusted gross income for single or 200 for joint, you get that phase out of that interest deductibility there. So in addition, one thing that is going away then is the $7,500 tax credit for electric vehicles. So September 30th. So if you were in the market to purchase an electric vehicle, you might want to get on that. Other than that, go buy yourself a new vehicle, I suppose, if the interest deductibility is attractive to you. I have my own thoughts on that, but we can chat on a one-on-one basis. So at the end of the day, the other one that was a big one, of course, in addition to tax-free Social Security, was no tax on tips and overtime. So again, this is a temporary. You can see a little bit busy here in the slide for tips. Up to $25,000 a year. You do have to be an eligible, worker, if you will. So those are typically ones that are in the food service, industry, and others, right? And it does flow through your employer. So obviously, cash is cash, but ones that flow through your employer to your pay stub, they do qualify as well. Overtime, you have up to 12,500 or up to 25,000 for joint. That would be overtime specific. So you'd say typically hourly workers, over 40 hours, not salaried individuals, unfortunately, don't necessarily receive overtime that often, but our hourly folks, out there, certainly anything over 40 hours is typically overtime, time and a half, double time, whatever the employer, kind of counts. So now those additional dollars would be tax-free up to the maximum additional 12,500 or 25,000 for a year. Okay, and again, income phase outs, of course. So the IRS certainly doesn't want us to have high income and tax-free income. So there is that 150,000 for single, 300,000 for married kind of phase out income level, right? So good, good for most people, obviously, and we'll see some savings on some dollars there. So I suppose go work hard, make more money. You'll get to keep more of it with these tax provisions. So at the end of the day, that's the kind of the high level view of these new provisions. Really wanted to break them down into hopefully an easier format, not make this all day long tax webinar either. Of course, if you have any questions about any of these or your individual situation, that's what I'm here for. In the meantime, enjoy the rest of your summer. We'll see you either before tax time, maybe at tax time. Good thing to note here, we do provide tax prep service. If you are interested or looking for someone to help with all of this, we are here, and I'd be happy to have an initial conversation with you. Until next time, have a good one. We'll talk to you soon. Thank you.